Hello, real estate investing fools, and welcome to another Millionacres Spotlight. Today, we're doing a deep dive on logistics real estate, a topic that is essential to our lives, whether we think about it or not, and an area in which there are so many investable ideas. And my guest today is Allan Swaringen, who serves as President and Chief Executive Officer of JLL Income Property Trust. He has a total of 35 years in real estate, 24 with LaSalle, and as the leader of LaSalle's initiative to offer institutional real estate solutions to high net worth private clients, he's the founder of JLL IPT, which is the first daily valued multi-share class diversified perpetual NAV REIT. Well, that sounds like a lot. So let's start there. Tell me more about what that is.
LaSalle Investment Management, the money management arm of our parent JLL, similar to your platform, we've been working tirelessly over really about 10, 12 years to bring real estate solutions that our firm has been running for 40 years to high net worth individuals. And the culmination of that is this solution we launched back in 2012. But it's very much focused on bringing high quality institutional managers such as ourselves who buy high quality institutional properties that normally are outside the investment range of high net worth individuals. But the goal there is to bring together a portfolio like that and offer it through financial advisors. So our solution is only available to investors on the recommendation of financial advisors. So we sell through and offer through the intermediary channels. But it was a very unique construct. There had been kind of what used to be called non-traded REITs offered to high net worth individuals for years. And we felt like we could and should build a better model. So that's what we built in 2012. And it's had great adoption through the financial advisor community. It's very focused on being a stable value and income solution, which I know you hear from investors all the time. But that's what folks are looking for, stable value and income. So that's a little background on that vehicle, but it's really more about bringing high quality institutional real estate to the broader market, not just having it exclusively for the largest pension funds, foundations, and endowments in the world. So we kind of share that passion to what your platform is. Interesting.
So as I understand it, was the first REIT of its kind, right? And so how is it different?
A couple things that make it quite different. First off, it's diversified. And historically, the non-traded REIT industry was offering solutions to advisors that were single property type focused because they were, for the most part, the exit strategy for those prior version of the vehicles. We call it the 1.0 version, and we like to believe we built the 2.0 version. The 1.0 version of this solution, the exit strategy was to go public and create a public REIT solution, and investors would get a liquidity or at least an option to exit the stocks via the public markets. So that led the funds or the strategies to be single property type, because as you know, the public real estate markets, the listed traded market, really likes single property type. So our solution is quite diversified though. We own multiple property types across multiple markets, and that made it quite unique. The other thing that made it quite unique was it's actually designed to be an open-ended perpetual vehicle. And so it never shuts down. And we make a market in the shares, and through regular, very rigorous valuation methodology using third-party independent appraisers, we strike a valuation, and that's the basis upon which money comes into the vehicle and that money can then exit the vehicle. So versus it being kind of a closed-end fund that has a beginning and an end, we were trying to build a solution that, was like a little bit more like a stock mutual fund, but made up of private, real estate, direct real estate investments. And that made it quite different. I'd also say it was quite different and unique that our distribution strategy is focused on the whole advisor community, not just a single channel. So we've been quite fortunate to gain adoption from the largest wirehouses, the largest RIAs, and even the largest independent broker-dealers in the world. And the history of the legacy non-traded REITs was kind of their domain was the independent broker-dealer world. Last point of differentiation is we brought the fees way down. So more money got invested in real estate for the investors and less fees being taken out up front, which was kind of one of the criticisms of the vehicle prior to ours.
So it's a perpetual NAV REIT. What exactly does that mean?
The perpetual nature is it's open-ended. It's been up and running for 9 years, and we hope it's up and running for 30 or 40 or 50 years. It really has no end date. Money can come in and out. And so that makes it perpetual. Its NAV characteristics, Deirdre, is kind of interesting in that most people that look at the public REIT market talk about the traded REIT market. Often analysts that cover the traded REIT market talk about public REITs often trading above or below NAV. So sometimes people would say, hey, it's a great time to invest in REITs. The share price actually is cheaper than the underlying real estate. And then sometimes people, analysts will talk about public REITs. Oh, actually they're trading above NAV. Our solution, the theory behind it, is that it trades at NAV. So we have a rigorous valuation methodology where every single property in the portfolio gets independently appraised every single quarter. So 4 times a year, every property gets appraised. And we try to offer shares at what we think is at NAV. So versus kind of a historical non-traded REIT that used to keep share prices at $10 forever, our share price can go up. It went down a little bit during COVID last year, but it's recovered nicely, and investors can come in and out at NAV. So it's a perpetual NAV REIT. That's the kind of engineering behind the name.
Fantastic. That was a great explanation. So you mentioned you're diversified. What types of properties are you looking at, and where? Is it only U.S. based?
Currently, we are invested principally in the United States. If you've read our prospectus, we are allowed to invest outside the United States, and the advisor to the fund, LaSalle Investment Management, is a global real estate investment management firm. Our firm today manages about $75 billion of real estate investments all around the world, principally for institutional investors. So this is what we do in the high net worth space. But in terms of, so our focus is currently in the U.S. and I really, that's what we've been doing for about 9 years. And we still see better risk adjusted returns from the U.S. real estate markets than we do outside the U.S. right now today. There's a lot of global noise, in terms of True. Markets and economies. So anyway, our focus is in the U.S. But in terms of what we are doing in the United States, our largest allocation today is to multifamily apartments, mostly garden style apartments. We got about 1.2 billion of multifamily apartments. I think 18 apartment communities around the country. Our second largest allocation, also at about 1.2 billion, is warehouses. So 2/3 of our fund today is either apartments, mostly in suburban garden locations, or industrial warehouses, in what we consider to be primary distribution hubs. We also own medical office buildings. We own life science buildings. We have 2 parking garages. We own grocery anchored retail. We have a little bit of office, very underweight to office. We were underweight pre-pandemic to office, and that ended up being quite fortunate. And we're going to continue to be underweight to office kind of post-pandemic until the return to work sorts itself out. That probably has more work to be done there on the return to work.
Yeah, totally agree with that. I think we're not really sure yet what's going to happen there. Everyone I talk to calls it the wild card in real estate, and I would agree with that.
It's the big unknown right now, I think, of the property markets in terms of office buildings, and I think it's so great that you do things like this so we can educate investors and financial advisors about how to think about real estate, because a lot of people think about real estate through that office building lens, like that's the only thing out there. And it's a big part of the investable universe. About 40% of the real estate market in the United States is office buildings, but there's many other ways to do it outside of office buildings. So people shouldn't necessarily kind of vote with their feet and worry about investing in real estate because they're worried about offices, because I think we have a 7% allocation to office right now today. So that's pretty underweight office when the universe is 40% office.
Well, and you mentioned multifamily and industrial, which are, 2 of our favorite food groups, 2 of the, smartest ways to invest in real estate right now. I want to talk a little bit about some of the specific areas that you're investing in, because I just think they're really smart. You made some key investments in the Louisville, Kentucky area. I went to grad school in Louisville. I've been seeing things about the Louisville, Cincinnati area as a growing shipping hub. What is it that you're seeing there?
It's interesting. 5 years ago, we probably wouldn't even gotten on a plane or driven down to Louisville to think about owning warehouses there. But it has really blossomed as one of the strongest secondary markets. So when you think about investing in industrial around the country, which is our landscape, you're going to probably focus first and foremost on the 6 or 8 largest primary markets. But Louisville is one of those blossoming secondary markets, and a couple reasons why that is. First off, it uniquely has a confluence of 5 major interstate highways. I forgot all the numbers, but it's a lot of I's. I-47, I-52, and so there's a lot of interstate highways that come in and around Louisville. So it's really developed a very efficient transportation hub. Another unique fact about the Louisville market, within 1 day's drive from outside of Louisville, you can get to half of the population of the United States. Most people wouldn't know that. You can get to half of the population of the United States on the interstate highways that come in and out and connect Louisville. So it's really become a distribution hub, which is why UPS put both their Worldport, which is their air hub, and their Centennial, which is their ground hub of the whole United States in Louisville. So when UPS, which distributes more boxes than almost Amazon today, when they say, hey, our air hub and our ground hub are going to be in Louisville, that means there's some characteristics of that Louisville market. It's about 135 million square feet industrial market, which makes it, again, a second tier market, but it's still a big market. The other reasons why it's attractive is land is cheaper there and it's less expensive to build there as compared to Chicago. So I'm speaking to you from a northern suburb of Chicago, not far from downtown, not far from O'Hare. Land costs and where I live and land and building costs are almost 2x of what they are in Louisville. So if you can distribute the goods you want to distribute to half the country within a day's drive, you can actually do it at a much less much less costly out of Louisville than you can out of Chicago.
That's really interesting. So another market you're making moves in, probably more well known is as a hub, is Dallas and the Fort Worth area. So we've been keeping an eye on that one too. Our Mogul investment service just did a deal. Finally realized deal in Plano for Plano Industrial Park. What are you seeing in the Dallas-Fort Worth area?
So the overall DFW market is a very interesting market. And what makes it attractive to us today is it actually, Texas is a winning state. And what I mean by that is Texas is attracting jobs. It's attracting people. It's created a business-friendly environment. It has low taxes, and it has a good labor supply. And so companies and people are moving to Texas in a way that's never occurred before in the history of the U.S. And I've been in real estate for 35 years, and I probably spent the first 25. One of my prior employers, Trammell Crow, is based in Dallas, and I grew up going down there. And Texas was a market that was always prone to these massive peaks of overbuilding. You think about the S&L crisis and some of the significant downturns in real estate. Kind of a lot of them had their kind of point of most pain right there in Texas. But it has changed dramatically because of the friendly work environment, the friendly business environment, and attracting people there. So first off, when you have an area that's attracting jobs and people, that's really good for real estate. From the industrial side, where I talked about before, Louisville being kind of a strong, blossoming secondary market, the DFW market is one of the largest primary markets. It's actually the 4th largest industrial market in the whole United States, comes in at about 820 million square feet. So I said before, Louisville is 135 million square feet. DFW is 6 times Louisville just in warehouse space. So it's a big market, has great airport, number of different airports, both in the DFW airport, but up in Fort Worth, there's another airport. And here's another interesting thing. DFW, the whole DFW market has about 20 million square feet of absorption every year for the last 10 years. So what's interesting about it is even though there's been unprecedented building in and around DFW, there's been unprecedented absorption. So 39 straight quarters, which if I do my math, I think that's almost 8 years, okay? 39 straight quarters of absorption that exceeded new construction. That's a phenomenal statistic in that market. So that's why it's attractive to us.
And that's even before, way before the pandemic and the sudden, increase in industrial.
Very much so.
Well, let's talk about another area, which is Arizona. The trust has some properties in Arizona. I've been fascinated by how many people move to Phoenix. I find it really interesting, especially right now, very concerned with how hot it gets there and the need for energy efficiency. What are you thinking about Arizona in general?
So we've been big investors in the whole Arizona and in particular the Phoenix market across our whole fund. And when I say that, we own one of our multi-tenant office buildings in Phoenix in the Tempe area, and it's performed very well during the pandemic. We own 2 grocery anchored shopping centers up in North Scottsdale area. And I think today we own 7 warehouses. So we're invested in all 3 of the 4 primary property markets there. And I think we own 2 apartment communities, kind of in the kind of Mesa Southeast Valley area. So we're big believers in Phoenix. Now we start with where are people moving? And Deirdre, you mentioned that Phoenix has been the fastest growing market in the United States in terms of population for the last 10 years, almost 16% annualized growth. The only markets in the top 20 that have grown faster than Phoenix are Dallas and Houston. So when I said Texas is a winning state, the only state that's exceeding the growth of the Phoenix area is the Dallas-Houston area. So it's had good long-term population growth. One of the other interesting things about Phoenix and Arizona is it actually is the top beneficiary of the outward migration from California. So,
Definitely.
So everybody wanted to live in California. That was the great dream. There's challenges with living in California. And so the whole Phoenix area and Arizona is had its largest inbound migration is actually from California. So I think it makes sense to talk briefly about the strategy of our fund and because it ties into where we've been investing. This is a solution that's designed to generate income for investors. I mentioned that before. Also stable value. Deirdre, we don't do development. We don't do new construction. We're not building buildings. And for the most part, we're not buying broken buildings and fixing them up. We're buying high quality buildings in very good locations. And when you think about that and then you talk about, okay, we've invested in high quality warehouses in Louisville with long-term tenants, 10-year lease there. High quality properties in DFW and now in Phoenix. Those are markets because of the long-term demographic trends of job growth and population growth. They kind of check that box for us as far as delivering hopefully stable value and good income over the long term, which is what we hear financial advisors are saying their clients are looking for the most. So that Phoenix area, the other thing that we really like about it, and most of our investments are in the Southeast Valley area. So kind of from North Scottsdale, kind of down through Scottsdale, and then the Southeast, which also ties everything close to the airport. We're not big investors in downtown Phoenix. The city of Phoenix is still an area in which I used to joke about they kind of pull the sidewalks in at night. So in the downtown Phoenix area, but in that Scottsdale, Tempe area, there's great nightlife, there's great retail, there's great living, and you did talk about the heat. And certainly environmental concerns are a major issue in terms of investing in real estate for the long term. We have a huge commitment to ESG initiatives within our fund and within our overall business. And one of the interesting things about the warehouses we own there, many of the warehouses today, even in markets such as Phoenix, they often part of the office part will be fully air conditioned or heated, depending upon the season. But the warehouse distribution area are not necessarily heated. But one of the things that is occurring in the Arizona area, with a lot of these warehouses, solar panels on the roof. And so we're seeing a secondary source of income And it's if not even income, just a cost reduction from solar panels. And you're seeing that crop up a lot in warehouse buildings, especially in the Arizona area, because, I don't know, what is it, 320 days of sunshine there. And so you can offset some of those higher costs to air condition and heat by capturing the solar energy. And we're focused on doing that too.
I'd love to hear that. So what I'm hearing from you, it sounds like a lot of your properties are really located around transportation hubs. Sounds like you're also keeping migration as a factor. Last year was huge for migration. Do you think we're going to see that continue, or do you think that maybe that's going to slow down a little bit?
Again, I mentioned before, I lived in Chicago since I got out of college, and I kind of love Chicago. I'm a Cubs fan, and went to school here, both for undergrad and graduate school. But as much as I love this area, Chicago's had zero net population growth in the last 10 years in the whole Cook County area. And so we're not big investors here. And we are trying to identify those markets, Deirdre, where, people are moving to and jobs are moving to. As a long-term investor in real estate, when your time horizon is 10 years, there's two things you really need to get right. You need to get population growth right, and you need to get jobs right. And if you get both of those kind of critical success factors right, then you'll probably do well in owning real estate over the long term. Unfortunately, if you get either of those wrong, if you own a great building in a market where people are losing their jobs and moving away from, that's an investment that might not do as well as you thought it would. So we think some of the trends in terms of population migration, they're going to continue. Now, one of the trends that has changed in the pandemic, but we think it will recover, and we talked about it before, there had been a big trend over the last 20 years for our urban environments, our big cities, to get bigger, okay? And that has slowed down moderately due to the pandemic. But that is a long-term global trend that I think is somewhat inevitable. It's where jobs are going. It's where public transportation is. It's where entertainment and lifestyle is. It's actually where younger people want to be. I mean, I'm in the suburbs. I have two 20-somethings in college and just finished college, and they're tired of being in the suburbs. They want to get down into the city. That's where they want to work. That's where they want to live. That's exciting for them. That's a trend that I think is going to slow temporarily till we figure out vaccinations, public transportation, social reforms, things like that. But so we're underweight in the urban environments, and we're going to stay underweight there. But I do think they will recover, and I do think those long-term population migration trends, they're kind of inevitable.
I would absolutely agree with that. We've been watching Sunbelt migration for long before the pandemic. Let's talk a little bit about industrial real estate and valuations, because industrial real estate, traditionally not a very high price per square foot, keeps ticking up, and the demand, everything I'm reading, every report says that we need more than we're building. Is it getting really challenging to find the properties that are they're a good deal?
Deirdre, it's a very competitive environment today, and more so in the industrial markets than ever in my 24-year career here at this firm. And it really gets back to what investors are looking for, and the synergy between what investments in warehouses provide. Investors are looking for stable value and income. They're looking for investments that they have confidence will retain their value and hopefully appreciate over time. And they're looking for investments that generate good free cash flow. And in terms of rents that fall to the bottom line, when a tenant pays rent, and then off of that, you've got to deduct the expenses of the taxes, insurance, utilities. And then, after paying the expenses, generating free cash flow, there's not a property type that generates more free cash flow, net free cash flow, than warehouses. It's amazing. Office buildings, landlords have to significantly invest to retain tenants. Apartments require more maintenance and upkeep, and they have more operating expenses, and you have to have leasing agents and property managers. Retail is just slightly above industrial in terms of free cash flow, but there's more to maintain there. You have to keep the tenants in place, clean the parking lots, do all that. There's not a simpler format of real estate to own in terms of generating free cash flow than a big 400,000 square foot box that the tenant maintains everything and is responsible for everything completely of it in terms of generating free cash flow. So investors today who are so yield starved, they're so looking for income. There's actually not a more attractive real estate investment than warehouses to meet their investment objectives. And that's, we think it has room to run. So that's on the capital supply side. And then e-commerce. Deirdre, the growth of industrial and warehouse real estate is being buoyed by the e-commerce and even, another factor that you had mentioned before, kind of reshoring and in manufacturing and distribution kind of coming back to the United States and post-pandemic. So we think it has more to run, but it's very challenging to find the investments that we're looking for. Our experience, our track record, and our relationships with both developers and sellers of real estate really differentiates us. And we've been able to grow our portfolio significantly, but it is competitive, and cap rates in industrial are actually at an all-time low.
Well, last question for you. You used the word box earlier. One of the things that I've been fascinated about is I feel like the box of industrial real estate is set to change. I know Amazon is making investments in robotics. I've seen so many startups focusing on robotics, automation, and logistics. You mentioned UPS earlier. I know that they've been a big leader in that. How is that factoring into what you're looking at right now? Yeah,
Deirdre, two things I would comment about that. When I first started cutting my teeth in real estate, 30 plus years ago, the average clear height of a warehouse building was 24 feet. And what that means is, if you were going to buy a state-of-the-art warehouse 25 years ago, you kind of didn't want to buy anything with a clear height roof below 24 feet. The state-of-the-art warehouse today in terms of clear height is 40 feet. Now, it's stacking and racking, okay? Tenants pay us, the landlord and the owner of the building, a rent based upon the square footage footprint of the building. They don't pay us more rent because the building's higher, okay? So in terms of being able to, whether they're doing light manufacturing, whether they're just distributing, racking systems today have become more and more efficient in terms of stacking things higher and higher and using robotics like you talked about. So, the efficiency of these warehouse buildings continues to grow by them getting taller and taller. And it's a very interesting dynamic. My firm also invests in warehouses around the world, and early stage, this is 6-8 years ago, we were one of the first firms that started building multi-level warehouses in Japan. And you can go to the markets in and around Tokyo, and they have 5-story warehouses with circular truck docks that go up to them because the cost of land is so expensive. So when talking about going just not 40 feet vertical, 5 stories vertical, and so now the other part of that, which we find even more interesting for the sector and the asset class, is the robotics investment that these firms put in the buildings actually makes them quite sticky tenants, and they tend to stay longer. And because they have a significant capital investment, we'll build the building for them, but we give it to them empty as a shell and core. Then they might put often 10 to, if it's a $40 million warehouse we build or we buy and they lease from us, they might put another $20 million of robotics and racking systems inside that building, which is very expensive to install and very expensive to take out. That actually enhances kind of the long-term benefits of that tenant and our belief that they'll not just have a 5-year lease or a 10-year lease, that they'll renew and stay. So it's actually enhancing the asset class when you're seeing some of the mechanical investments going into those buildings. Yeah, it's definitely one of the things that I think all of us are going to be watching. Well, I could talk to you all day, but I know I have to let you go. So thank you for your time. Investors, you can learn more about the perpetual NAV REIT at JLLIPT.com. Stay well and stay invested. Thank you.